a great way to get money and time and energy and enthusiasm is to cut. It is easier and quicker to stop doing work for the customers you're losing a lot of money on than to find another great client. For some people, like, don't I need to sell more before I cut? The reality is we don't find people being very successful if they try to continue to do what they've been doing and hasn't worked, which is to try to sell their way out of a profit problem. I think many people feel that their profit problem is a revenue problem, so they sell their way out of it rather than fixing the profitability of their business and then selling more on a very profitable kind of model of what they're doing.
Ben Hansen is a seasoned entrepreneur and business consultant known as the Profit Doctor. He built an 8-figure consulting business in just 8 years,
earning 5 consecutive Inc. 5,000 awards. Today, he helps companies from $5 million to $50 million cure profititis and achieve healthier bottom lines.
Absolutely. You know, I just love working with business owners to help them improve their profitability. And probably one of the first things we help them understand is that revenue and profit, while they often ride along together, often not always going in the same direction. Mm-hmm. And so after years of having my own business and being in a group called Entrepreneurs Organization here in the United States, I just met so many business owners. EO, not quite EOS. EOS is more like a entrepreneurial operating system. And then the Entrepreneurs Organization, almost the same letters, is a group of about 17,000 business owners around the world, including Australia. Right. And anyway, being a part of EO for all those years, just talking to so many different business owners when I had my own company, and just so much challenge for so many of them, where it seems like from the outside the business is doing well, but under the covers profitability is not good, cash flow is not good, and it's kind of a real challenge. And so now I love working with business owners to help them improve their profitability.
I mentioned to you offline, like one of the things that we see often is when clients come to work with us over at our marketing agency, they're very often coming out of the word of mouth and referral model, and they're looking to scale with consistency. So for that reason, they need, marketing. And at that point, they need to understand that there needs to become like a marketing budget allocation as part of their product pricing and costing, which often a couple of times we've seen, clients that all of a sudden start closing all these jobs, and like their job consistency is going up and up and up and up and becoming better and better in terms of closed jobs. But they're like claiming they're not making any money, and it's always because they haven't had that allocation put into their operational expenses to make sure that they are budgeting for, within the price of their product, that they have that allocation to fuel the marketing for the next projects and so on and so forth. And so it's a pretty common conversation that we have to have.
Yeah, here at Profit Doctor, because we have the medical theme, we have classified a condition that we call profititis. And that's when your revenue is going up, but your profitability is pretty much staying flat. And sometimes when I work with, more blue collar guys that can take a better joke, I call it low P, kind of like low testosterone, low T, but low P for low profitability. And You definitely touched on a few of the key things. What I would take away from what you said is when people don't really understand their costs, whether it's gross margin or net margin or contribution margin, then it becomes very difficult to understand what the profitability would be, what the budget they might have, of every 100 cents of revenue, how many cents might be available for demand generation and marketing.
I've seen as well a few scenarios actually where, like on paper, I suppose the business is looking profitable and healthy. However, when you break the actual business down, certain areas are far more profitable and not enough resources being applied there. And I'll give you an example. Like many, many, many years ago, we were working with a plumbing company in Western Australia, and they were about, I think at the time, maybe 15 staff, so decent size. and they had what we call commercial division, which is essentially like projects they were working with, builders and like construction sort of based work. Still on the residential side, like building homes and that kind of thing, but working with builders. And so they had this commercial division and they had this residential division. And when we started working with them, we were looking at the numbers, and so 90% of their resource was taken up in commercial, in doing buildings and stuff like that, working for builders. But the profit was about 15% over there. But on the profit and loss statement and the balance sheet, that's where the majority of the business's revenue was coming from. But it just wasn't as profitable. When you look at the residential market, where they were doing reactive work, so block drains and service-based, work, the profitability was huge over there. But it was the profit percentage was huge, but the dollar value was low because all of their resource was taken up in commercial. So when we sort of broke that down and we could identify with them, well, this is what we're sacrificing on the profitability side by having all of your resources over here. Like it was pretty transparent. Of course, the bookkeepers and the accountants shit the bed because they were like, "What's going on here? We're going to, all of the like that," because they see the dollars, right, and everything's starting to drop, but the profit was going up and up and up and up and up, right? And so it was one of those weird years where all of a sudden there was this transition from, mostly commercial, where the dollar value of the business turnover went down, but the profitability was going up and up and up and up. And they eventually moved more or less entirely into that residential space, and then they sold it. They did a really good job. But the point, I guess, is it's sometimes these things aren't obvious until you really start peeling back the layers and looking deeper into it.
Absolutely. The first thing you said is often a business looks good on paper, but maybe under the covers, it doesn't look that good. And I would maybe translate that to say, often when you think of the top line revenue of a company, things might look good. But then when you go deeper into the books and think about bottom line profitability, you see profititis, strong or growing top line revenue, but, weak or declining bottom line profitability.
I think one of the big lessons we learned along the way with that as well is making sure that your net profit percentage ratios and your net profit dollar turnovers are also in line, and they're all moving in the same positive pattern together. Because sometimes you'll see where you win a huge job, for example, and it's worth like $1 million, but the profit margin on it is like 8%, whereas your profit targets are typically 30%. So while your turnover goes up, your profit goes down.
Yeah, I mean, you're definitely touching base on a couple of things. The importance of, really understanding your numbers well enough to see, what is the margin going to be on a certain project. And I think so many people in construction and the trades will accept a job with a substandard margin, either to, keep people working, or they think they got to grow. But, probably the fastest way to lose money is to accept a bunch of money-losing projects.
Well, truth be told, and I came out of this world, many, many years ago as a former plumber, where and I was working for a company that at the time was a huge company, and the model back then was essentially, like they would price these projects on costs and try and make money off,
like change orders.
Yeah. And it was, and I was like, oh, okay, well, that's just the way it is, whatever. Like looking back, I was thinking, that's crazy. I mean, there was like 100 staff on the books back then, like huge payroll, super insane stress. The business recently went under, actually. This is 15 years later, but it was I felt like it was kind of teetering on that for the entire existence of the business. And I remember even the business owner then telling me, man, we were so much more profitable and there was so much less stress when I had 5 guys and a Jetta.
And that's the whole profititis thing, right? I mean, there's sort of this illusion, if you will, or I call it one of the big profit myths, is that so many business owners are so focused on revenue that maybe they kind of lose sight a little bit about profitability. Often they're making decisions, trying to get revenue, but maybe not seeing how that turns into profitability. And, not everybody. We look at the landscape and think that for every size of business in whatever industry they're in, there's sort of the above average profitability companies who usually are very focused around profitability and doing a lot of the right things. And then, of course, there's half that are below average profitability. And, you know, some of the biggest challenges for those folks is that they're so busy, you know, sucked into operations or chasing revenue that they don't have enough time carved out to really think through the profitability of what they're doing. And, you know, your example about, in that case, I think it was the residential work was highly profitable and the commercial work was not that profitable. You know, so common that every business has either multiple types of customers or multiple types of products, and all of those chunks are not equally profitable or beneficial for the business. But if you don't have the numbers, you don't understand them, or you're not thinking about profitability, you know, you're not connecting the dots. We have 3 segments, if you will, of our business: highly profitable, average, and low profit. Well, maybe if we exited, for example, that low profit or shifted more focus to the high profit, you know, over the next X years or months, we could make a big difference.
I think as well, it does bring to the surface some uncomfortable conversations in the space that, okay, well, you know, we're running this business model at the moment, which is on paper sort of working, but realistically, we're just trying to keep our guys employed.
Mm-hmm.
You know what I mean? Like if we move out of that into this, I've got to let go of 15 staff. I mean, like when you peel those layers back again, like that's probably music to a lot of business owners is to a degree, but I think that's kind of an uncomfortable conversation that they, you know, reality they have to face as well, which truth be told is most likely in their interest, but still, you know.
Yeah. You know, a lot of people are familiar with this famous sculptor, Michelangelo. I tell this story. He carved the David, you know, this big work of art in Florence, if you've been there. And apparently that block of stone that he carved it out of, and I will get to the point here, sat in the quarry for like 40 years. No artist would take it on because it had a big crack in it. Anyway, he took it on. He did this amazing masterpiece. And later on, they're like, how on earth did you do it? It must have been so challenging. It had this big crack in it. And he said, well, I just looked at the block and envisioned the David and carved away everything that was not the David. And the allegory here is, in your $5 million unprofitable business, is there a $2, $3, $4, $4.5 million really profitable business? And if you just take away the things that are kind of, you know, weighing you down, you have a really good business. So getting back to, you know, let's say you have 20 staff members, but 3 of them are on a chunk or a division or a service line or whatnot that is really costing you a bunch of money. Well, 3 out of 20, that's 15%. That might make a big difference in your business if you stop doing that area of work that just wasn't working for you.
I'm just typing in something into the notes here that I want to recap on in a little bit with you in the space of. Do you know Tom Howard? Anyway, Tom runs a very successful, or a number of successful businesses over in the US. He's been on the podcast a bunch of times. And we were talking to him about the dynamics around remuneration structures for team members and how to make them, you know, like incentive-based performance pay and things like that. And I want to circle back to that in a little bit because I think there's some things that I'd like to unpack with you. But I know you talk a lot about the 5 biggest profit killers in trade businesses, so let's definitely jump into them, and then definitely how we can maybe give the guys, the listeners and the viewers out there is a bit of a practical insight as to how you can simplify financials, you know, and maybe ascertain a bit more financial clarity within the, you know, the running of the business.
Yeah. You know, maybe a nice little framework to get people started would be what we call the profit prescription. And we kind of break that down into 4 chunks. The first one is profit psychology. And as I kind of alluded to, so many business owners, they're just sucked into operations and revenue, and they kind of lose sight of profitability. A lot of times the numbers that they're getting from their bookkeeping or accounting team, kind of hard to understand, or they're not really a numbers guy or whatever, but they kind of take their eye off the ball on profitability. And so that first chunk of our prescription is just to help people laser focus, like, hey, you really need to take some time and some focus around profitability. And it sounds kind of dumb and obvious when I say it here, but the people who are in the, you know, bottom half, bottom third of profitability often the reason that they got there is it's not like easy for them. It's not second nature for them. And they've kind of got sucked into some other things. So number one, to focus on profitability. Number two, and we even have a course around this, we call it the Profit Accelerator, is to stop doing the things that are costing you money or stop doing the things that are broken. And so many business owners in the trades, they're wired to fix stuff. They're like Mr. Fix-It, right? So when something's broken, they want to fix it. And what I would suggest is that many times in your business, things that are broken or not working for you, you shouldn't fix it. You should just stop doing it. And so perhaps in that example that you were talking about, maybe consumer work is good and profitable for your business, and commercial work is not good and not profitable, and you've been trying to fix it for 7 years. Maybe the smarter choice at this point is to de-emphasize that or shift away from that and move into the consumer part, right? So that's an example of stop doing the things that aren't working. That's sort of our 90-day program that helps people increase their profitability. And then the third area, we call it Profit CFO. So many people in the trades, they who own businesses in the trades, they came up through the trades. They didn't start like, I was a finance guy, and then I went to Wharton for MBA, and then I decided I'd become a plumber, right? And I'm really good with Excel and spreadsheets and all the financial stuff. They started off being a plumber or being a framing contractor or whatnot. And so the net of it is many people don't have the right people on their staff or not getting the financial information, education, and explanation that allows them to really have the numbers be working for them. And so when it always seems chaos whenever you're trying to think about the numbers because you can't get a clear answer or a real good read on what's coming from that, again, that also reinforces, I'll just work harder and sell more stuff and do more jobs, So the third part is what we call Profit CFO. It's kind of cleaning up the financials, simplifying it into our easy financials. So that's like get insights from that data. Usually it's simplifying things and a little education.
I've just been through. Yep. Oh, sorry. Go ahead.
And then just the fourth part we call Profit Growth. We have another program for that, of course. And the idea there is if that second chunk was do less of what's not working, the fourth chunk is do more of what works best. So selling your best stuff to your best customers at full price through your best sales and marketing vehicles. And the combination of those four parts takes a business that's, good at plumbing and turns it into a business that's good at making money. And that's kind of our goal.
I recently went through an exercise with my bookkeepers because we were building out, again, what got us to where we were isn't going to get us to where we were going. And so we had to clean up, we had to build more detailed we had to build better reporting. I say more detailed, it's not actually the case. It's more simplified.
Typically, the problem is too many numbers on the sheet, not enough.
Right. And so, and it was one of those scenarios where when I started the business, like over in Australia, we use Xero. I know you guys use QuickBooks and all these kind of things, but essentially sort of for the better part, set it up myself. And it got to the point where it kind of got us to where we were without too many headaches. But then looking forward, we could see it was just a mess. So we had to tidy up all of the, all of the chart of accounts and all the line items and all the, understand which profitability across different sectors within the business, all this kind of stuff. And it was a bit of an exercise. It took a couple of months to get it dialed in. But the reason I raised that is because it's a very common scenario where you see people don't have the cleanest, clearest data, and it's very hard to make good decisions without good data. And so as much of a punish as that was going through and sort of stripping all that back and sort of getting it dialed in, it's necessary within the bigger picture, because it really is like now we look at it and we go, wow, like this is chalk, and like we have the data where we can really pull levers to really, get these things moving the way we want them to in line with our forecast.
Yeah, 100%. I mean, I'm glad that you clarified. It wasn't that we needed to have more detailed data. It's typically we need to have more simplified data. And so it's like too many numbers on the page and yet not enough information. So if you want to win and you want to scale, You got to get your financials cleaned up, and cleaned up isn't always a question of every number has to be perfectly accurate. A lot of times simplifying things to fewer numbers, but maybe more important numbers, even if they're an estimate, is going to be more valuable. Yeah.
A prime example of that for you guys that are wondering what the heck we're talking about would be, and this is what I was guilty of, because I thought that it was super important for me to have built into, the cost of goods, for the business, like all of the individual line items within the P&L, so I could see specifically, what we were spending on software and all these kind of things. And I realized that it was just leading to like paralysis, like there was just too much stuff in there. Whereas now I'm like, I just want to know what the cost of goods sold are as a whole. And then if I want to dive deeper, I can, but as long as I can manage that, like that's simple in the reporting, and we can keep that as a pretty consistent line item, and we can gauge that looking forward. The same with team, even truthfully, like, once you get to, 15, 20 odd stuff, like it's important to understand when you dive into them, what you're spending on, on each individual. But like more importantly for an overall report, like what are we spending, on staff costs this month or next month, and just know what that number is as an aggregate.
Yeah, you're totally nailing it, Matt. I mean, I think what's common with people who are less comfortable with the numbers is they feel like they need to absorb them all or have all this detail. And they often miss the big trend, the main message, because honestly, there's too many rows on your P&L. And previously you mentioned chart of accounts. Funny thing that I've learned is that a lot of business owners think that each line item on their P&L, somehow maybe the government or the accounting standards said that had to be that way. It turns out somebody just made them up, probably when you were first starting your business, and over time people started adding more. But now maybe you've got 7 pages on your P&L and it's a big giant mess. One of the things we do is we create a simplified version, maybe 1 page, ideally, sometimes 2 pages, depending on the sophistication of the business, because you want to be able to see the whole forest before you then drill down item by item. So we invite people in a monthly financial review. You want to get the big picture, and then you start thinking, over the last 6 months, our labor ratio has gone up or our materials costs have gone up. Now we want to dig into, look at every little line maybe for the last 6 months on materials and be like, why has it gone up? But you don't want to start there, because then you lose sight of the big message.
I think, and you touched on something there as well, which I suppose we could unpack now, but like in relation to a business that is growing, and it's important that when you have the clarity on the numbers, and more importantly, it's important that you understand how the percentages and things work and at what point you're willing to bring a team member into that dynamic. A lot of business, and I've been just absolutely guilty of this in the past, where I thought the answer to growth was to throw more staff at it. Mm-hmm. And I learned that the hard way. That is not the answer. It is almost never the answer. Without doing it, you need the strategy, and you need to make sure that, and the team needs to understand as well, especially if you've got remuneration based, performance based incentives for team members. They need to understand that by adding more team members into that dynamic, then the targets all get shifted around. The targets change because essentially that team member's salary or package or whatever it is, absolutely affects the profitability of the business at the end of the quarter or the year, so on and so forth. So I just encourage you guys to really think hard about, at what point you need to introduce team members. I'm not saying that you don't need team members to grow. You absolutely do, but you need to do it the right way.
Mm-hmm. Totally. Something that you were just saying that reminded me of a story, a client that I started working with earlier this year. A New York-based security company, like alarm systems and things like that. He told me, they just did a kind of a customer success video, that the biggest change is they shifted from doing great work for clients to the whole company understanding that their job was to do great work for clients, profitably. And what I thought was so interesting, because it ties to a lot of what you were saying, is in many cases, the people doing the work didn't understand that profitability was really darn important. And then they didn't have the kind of the data or the information for it. Like the guy who was sent out in the truck to go do the work didn't know that this job had been allocated, let's just make it up, 35 hours to complete. Well, if they're merely, we'll just make it up, drilling and hammering and running wires and whatever, and they don't have a sense of what the budget is, often what will happen is they're 80% of the way through the workload, but only 50, or the budget of hours, but they're only 50% through the scope of work. And then that continues to create this situation where projects are being delivered unprofitably. And even if it feels like a win on one dimension, we have a happy client, we won a project, even got a testimonial, who knows, good Google review, you're losing money. And so you got to kind of tie that together, and that's sort of combining the data, the remuneration, as you were mentioning. You want to make sure that the people doing the work don't have an incentive to be busy. They have an incentive to get that project done in 35 hours to a high quality standard, right? Not just get the work done.
The other thing that we see pretty common as well is the counsel that that clients are receiving from their financial, like their bookkeepers and their accountants and things like that. And the observation that I've seen is that a lot of these stakeholders within a business have very much like a preservation mindset. And what I mean by that is they're like when the bookkeeper looks at the numbers and they say, "Oh, hang on, we can't keep doing this. We have to stop because it's affecting your profit." Instead of, for this to be valid, we need to make sure that we're charging more to be able to be spending the money we're spending here to fuel the growth in alignment with the goal that you have set. And there's often that disconnect where the accounts are trying to save them money by telling them to stop spending, but then we're saying, well, if you want to hit your target, you've got to spend more.
Yeah, I might come at that a little bit of a different point of view. I would say that the average company in the trades, let's say doing $500,000, maybe even up to $5 million. And I've worked with plenty of companies, 10, 20, 100 million, where the people who are, quote, advising them from a financial standpoint, maybe not really giving them the best financial advice, as you're saying, in terms of how to run your business. In many cases, the smaller the company, people are getting bookkeeping support and then a CPA, or I guess maybe a registered accountant, you might call them, to do your tax return. But they are not really giving a lot of business advice in the sense of how to have a profitable company. Yeah. They're often not really training CEOs on what to be looking for in the financials. They're not simplifying those financials to make it easy to understand them. There's often a sense within the community of bookkeeping and accounting that our job is to make sure that these numbers are accurate and the right data goes in the right box. And there's certainly a place for that, and it's important. But that is not a substitute for excellent financial type advice on how to make your business more successful, how to be more profitable, how to read those statements, how to simplify the statements so they're easy to read for, let's just say, a guy who didn't go to Harvard to get an MBA. You don't want financials that you have to have a CPA to read. You want something that you can read.
Mm-hmm. Yeah, and I guess that's kind of the point there. But I mean, even recently, like I know I kind of touched on it before, where we had a client who's, he's growing considerably, spending a decent amount of money on. Well, actually, truth be told, not even spending what we would see as the average percentage-wise to get the growth that he's getting. Like not even close. But like when he had the meeting with the accountant was like, "Oh, hang on, you're spending way too much money over here," and so the conversations weren't aligned. In the sense of like, okay, well. But this is my goal, this is my target, this is what I want to hit. And like you say, if you had the right counsel from somebody that had a better understanding about business growth rather than like managing like the books, then there would be a better alignment there, because they'd be like, well, hang on, no, this is the target. We need to hit this, so we need to increase our prices to make sure that we're accommodating for that. Like those kind of conversations need to become reality. And those conversations, in my experience, typically you don't have with your accountant.
I'd agree with that. I think that, smaller to mid-sized companies, and particularly when the people who are the numbers people have a bookkeeping title, office manager title, accountant type title, it's a little bit different from a finance title or a CFO title. And as you get more into finance, more into CFO, more of a sophisticated executive thinker who's a numbers person, do you start having those conversations? But as you're saying, if you're trying to invest in demand generation or marketing to bring in more customers, and quote, it's working, and particularly if those customers are good customers who want the kind of thing that you sell, that kind of like right down Main Street, not bargain shoppers that want free stuff that you can't make money on, then you have to be clear, right? I mean, what you're trying to accomplish and what you're spending and what you're getting out of it. Those three circles have to kind of align.
Yeah, exactly. I think as well, and sort of tying back to what you were saying before about, coming out of the trades and not really having the accolades that come along with, tertiary education from financial, institutions and things like that. A lot of the biggest thing that we see is the lack of overall strategy when it comes to like defining the target, the goal, and then, identifying the milestones that can help you get towards that goal along the way. And we see that as probably, one of the biggest things that like we do with business. We're like, well, we can have this thing provided we do these things to get there, and even that conversation alone is often a revelation because they never really, it's something that hasn't really crossed their table often.
And again, it's so easy to get sort of sucked in to operations, delivering on projects, focusing on sort of the next sale, not to have a chance to sort of step back and be a little bit more mindful, planning, strategic, et cetera, and think forward. But maybe we could just jump into something. You've got 5 people, 10 people, 20 people. Like, what might be the next step that could help you do that? And you think that would be helpful, Matt?
Please.
So I want to talk about that step 2 in the profit prescription that I was referencing as the profit accelerator, where we do less of what isn't working. That's taking the things that we've identified as sort of broken, and in many cases, instead of trying to fix them, to exit them from the business. And let's just, we do offer a profit leaks assessment, and we'll get that into the show notes here. It's a free tool, and it sort of helps you identify which quadrant of your business maybe you're leaking profit the most. And another way of looking at your biggest problem, so to speak, in that area is what might be your biggest opportunity. But let's just pretend that your biggest challenge is clients. So you know that you're taking on a lot of clients that are not very profitable and a giant pain in the butt. And that's often manifests like they're not happy, they take a lot of extra time, they're requiring you to do rework, they're unsatisfied, the costs sort of skyrocket compared to what you bidded it for, because again, there's something wrong there. So when you identify, let's say of your 100 clients, which 20 or which types of clients are really unprofitable for you, it can be very, very effective that once you identify either clients by name or different categories of clients where you're losing your money, if you stop servicing those clients, it's almost like addition by subtraction. I think of like a hot air balloon. The hot air balloon wants to go up, but you've got all these sandbags, tied to the side of it. And the second you sort of cut that ballast off, the hot air balloon can shoot up. And that's why we have been so successful helping companies very quickly increase profitability, because that lever of getting rid of the things that aren't working can be incredibly quick to improve profitability for, we'll call it small to mid-sized companies.
I've noticed in the past, so like this whole defining your avatar conversation, which is extremely important, and especially when it comes to creating messaging around like let's say for the purpose of like lead attraction, like running ads, building websites, that kind of thing. Like, okay, who are we actually talking to here? Like, it's a very important conversation. But what I've found is that it also becomes like a luxury of consistency, and a luxury of like when you're generating, when you have a lot of inbound inquiries and you have a lot of people, you know, coming to you, you kind of have more leverage as to who you decide you want to work with. Whereas a lot of guys,
Absolutely, yeah.
like, well, I need to take whatever work I can get because I'm scrounging. You know,
Yeah.
I'm going to pay the next bill.
You know, there's a couple of parts to that. I didn't mention it, and I should have. You know, when I talked about the Profit Doctor 4-part profit prescription, psychology, stopping doing what isn't working, getting your handle around the numbers and those levers, and then doing more of what works best. What we see so often is that while people think they're trying to work on that other top quadrant there of like get more business, they're often so busy and under-resourced that they can't really devote enough attention to that. And sort of counterintuitively, a great way to get money and time and energy and enthusiasm in order to tackle that quadrant is to cut the stuff that's not working well, partly because it's very fast. It gets you a lot of time back. It puts money back in your pocket. And it is easier and quicker, we'll just say, to stop doing work for 3 customers that you're losing a lot of money on and that takes forever to collect from them than it is to go find another great client. And once you have recouped some of your time and energy and cash by getting rid of some of those broken parts of your business, then we invite people, okay, invest some of that back in yourself, take a rest for a minute, a mini vacation, some time with your family, pay off your credit card bills, and then reallocate the other, let's say, half into getting more of your best clients. So that's a little bit of our prescription. And again, when you're not spending so much time on the broken stuff, you then have time to allocate to get more good stuff. And it sounds a little backwards for some people, like, don't I need to sell more before I cut? The reality is we don't find people being very successful if they try to continue to do what they've been doing and hasn't worked, which is to try to sell their way out of a profit problem. I think many people feel that their profit problem is a revenue problem, so they sell their way out of it rather than fixing the profitability of their business and then selling more on a very profitable kind of model of what they're doing.
Do you know one of the other things that we see more common than anything in this conversation around scaling with profitability is the biggest bottleneck by far, absolutely without question, becomes process. What I mean by that is and again, like we see this with most clients that we bring on, especially if they're coming out of like organic sort of based referral, word of mouth sort of the dynamic where, you'll never get a better lead than that into cold traffic. The biggest mover that we see is tightening process, because generating the leads, truth be told, and the conversations is not the hard part. It's almost always the conversations that have to follow that in order to move that contact from being a lead through the various stages of the sales process to where they're becoming like a market sales qualified lead.
Like conversion,
exactly.
Yeah.
And so, and very often we see one of the biggest movers, like the biggest thing that businesses can do in order to improve that is amend and sometimes just completely rebuild the process in a line with this, and of course we give them this and we train them on it. But the point is, like, it's a very different to what they were doing. And of course with change comes resistance. So sometimes they're not always willing to do the thing, but we see that all the time.
You mentioned strategy and execution. What I would say is, to me, this point you just raised about process, totally right. If you're let's just pretend you're now accepting 20 new telephone call leads a day. If you don't have a process to convert that, you're probably leaving half of that on the table or something, or you're not collecting it or whatever, right? Not converting it. What I'll also say in terms of strategy, a very, very powerful way to also improve conversion is to narrow your focus or narrow your field a little bit to the areas that you're really well suited for. So in that example you gave previously, where I think you might have said it was a plumber, but it could have said electrician, who was doing, business work and consumer residential work. Well, let's just say they suck at commercial work, but they're still trying to buy those leads. And now they're getting leads of both types in. They're not very effective at converting those, and their staff doesn't really understand them, whatever. Imagine how much better off they would be if they narrowed their field to the areas that they're really good at, historically very successful in, both profitability and conversion and all that. And then, every lead that comes in, theoretically, or much more of them, would be residential. The team is more able to do it. The processes are going to be a lot more simple. So I kind of like tying both of these things together. Of course, process is going to be really relevant. And when you narrow things down a little bit to the things where you're really successful at, it also makes the processes so much easier, because you don't have to route things in 50 directions. It's more, 2 or 3 lanes instead of, 30 lanes.
Yeah. I mean, the big observation, I think, is the fact that there's different levels of intent with inquiries based on where those inquiries come from. And so when you're talking from the perspective of like lead generation, like if you get a referral, that you'll never get a better one than that if it's come from a trusted source, friend, colleague, so on and so forth. And then you've got, through different platforms, like there's these lead aggregation sites, all over the place. So for solar, there's like these places where people go to this company and they say, oh, we want solar. Then they send out, okay, we need 3 quotes, like that kind of thing. And so that's a very high intent, because people know, okay, we need a solar package we want a solar package on our house. Even like a Google ad, for example, where somebody's typing into Google, solar company near me, like there's a high level of intent there. And then when you've got, say, other platforms like Meta and Facebook, it's a lower level of intent, because you're sort of speaking to people that don't know they yet have a problem. Now, there's not to say that any one of them is any better than the other. It's just a different way you have to handle that conversation to get that conversation to the conversion. And so when I talk about process, that's an important thing for people to understand. Like there's different conversations you have to have with people that are at different stages of your process based on where they've come from.
100%. And going back to that profit leakage detector, one of the dimensions that we invite people to dig into is their sales and marketing vehicles. And, you've got a lot of marketing background. I'm sure you've heard that there's an old quote that said, I know that half of my marketing isn't working. I just don't know which half, except they said advertising. Today with all this digital and online stuff, it's a lot easier to track. But, just like you were saying, Matt, if you've got 5 different, let's say, outbound marketing and advertising campaigns that have different flavors of inbound, first of all, some of those programs you probably don't want to do, and then because they're not working for you. And then the other ones you want to focus on making them work, because let's say, the meta ad produces people who are still a little bit more thinking it over, whereas maybe the Google ad is like, I need somebody today to, fix my hot water heater. So it totally makes sense.
And the biggest, I suppose, paradigm shift that we drive home so heavily with clients that we work with, especially in the reactive space, if they're electricians or plumbers or whatever it might be, or maybe they've got like a business which is subject to repeat work like lawn care and landscape gardening and these kind of things, even air conditioning to a degree. 3 letters which absolutely change the dynamic on all of their marketing: LTV, lifetime value. So, and we see this all the time when people are like, oh, we're spending all this money on lead acquisition, and I'm like, that's right. Then they go, but our ROAS, return on ad spend, or our ROI on this campaign is like we might even be losing money on the job that we won. The cost for us to win this job could be more than the actual ticket item on the job itself, which is truthfully not ever really the case these days. But back in the day, we would call that a loss leader. We were like, well, you'll pay more money to obtain this lead than you would, than you're going to get from the actual project itself. But lifetime value, you should be a mile in front. And this is where I think most businesses, and if you guys are in that basket, you need to understand this dynamic. It's not about what you're going to get from that first job. It's about what you're going to get from that customer over the course of the next 10 to 15 years, lifetime value. And that almost makes the cost of that lead acquisition in the early stages null and void. However, you must have a process in place which can help you increase your LTV. Most businesses don't know that.
Good stuff, Matt. And I would just amend that in that not every customer is created equal. Whether that's the ones who are just, say, price shoppers, and the second that your estimate is $5 higher than somebody else, they quit you and go somewhere else. Or a customer that's maybe a good customer, they're just not going to be a good customer for you. Let's just say you're all white glove, and they're like, hey, we're just flipping these houses. We need fast, down and dirty. We don't need it, to be, booties over the muddy boots, right? We don't care about that. We just want them to jump in and get out. So you'd mentioned customer avatar a little while ago, this idea of who is the ideal customer for you. And so when I think about our profit tools, we would definitely invite, you're trying to break through, you're $500,000, $1 million, $2 million, you've got 5, 10, 15 staff, you're trying to get up to that 5 million. Are you really going to beat everybody in every slice of your market? Are you going to out hustle everybody? A lot of times what we find is that if you looked over the last 20 clients, you really did such a great job and it was highly profitable and they love you and they're going to keep coming back for this slice. But then this slice over here was just a mess. And so by eliminating some things that are not working and kind of shifting those resources to the ones where you do best, that also helps you kind of like identify your avatar, shift your outbound, customer generation activities, whether it's sales or marketing investments to that. And then, if you're thinking lifetime value, those are the customers that are going to be successful lifetime value with you, right? Because they're really the right customers for you, not the ones that just sort of accidentally got caught in the net.
Yeah, a prime example of that is price. Like we have so many clients that do, bathroom renovations and solar and roofing projects and things like this. And, all day they're getting beaten on price by people that are just undercutting them, and the conversation for me is always, well, your avatar is not someone who's after the cheapest project. Like their focus is on quality, not price. And there are people out there that are willing to pay for quality. You just need to be able to communicate what that actually looks like, because they're not comparing apples to apples in this conversation or on the quote sheet. They're just looking at the bottom line. So that's really like the opportunity for you guys out there to be telling your story better and actually educating your potential customers about these dynamics, because they're not obvious and they don't know. And there's a huge level of ignorance within your clients. Like they don't have the same understanding of these things as you do. So you should treat that as your opportunity. And truth be told, like when they're coming to you as their trusted advisor, it's kind of your obligation. Like if you're not telling them these things and you're not actually identifying, okay, well, that's why this is so cheap and this is why we won't compromise on price and this is why we only do these things. Like that, if you don't tell them these things, then you're letting them down the path of, potential disaster, because you haven't been forward in identifying these, these concepts.
Yeah. One of the things you just mentioned, like there's some customers that, let's say, want the lowest price, other ones, a little bit in the middle, and let's say the other ones want, we'll call it the highest quality. It's going to be very challenging for any one company to be able to be the right company for all three of those types of customers. And when you try to service all three of those types of customers, it's going to be very hard to get your quality value message across to this, quality premium buyer. And at this, you kind of hear what I'm saying. I'm sure, Matt, you could probably say it better. But when you're not being clear about what's working and what's not working and kind of cutting the things that aren't a good fit for you, it makes it hard to win more and win more often with the areas that you're really good at. Because if you say we're top quality, best price, whatever, I mean, dang, isn't everybody saying that? How is that going to cut through and resonate? Because if you're trying to appeal to everybody, are you really going to take the steps, or you're really going to cut through, break through to the people you're really well suited for?
We call that permission to play.
Say that again?
We call that permission to play. You see this a lot with people like, we say, "Okay, what are your, why are you guys different?" Well, we're licensed and we're insured and we deliver great work and we fully guarantee our installations. I'm like, okay, but if you don't do all of those things, you're not even in business.
Yeah.
Like what actually makes you different? Like those things are actually conversion deterrents that we see, because essentially it's just noise and people just like glaze straight through it. Oh, we have great customer service. It's like, well, no shit, you're a business. Like if you don't, then you're out of business, like what are you doing differently? And I think this is, again, this is where you guys out there need to be really creative with how you communicate your point of difference, because at the end of the day, that's what's going to define you against, your competition. And we're kind of digressing, I suppose, on the conversation around, like profit and things like that. But when at the same time, it's relevant because you guys need to understand that it's not, you don't need to be everything to everyone. In fact, if you try to be everything to everyone, you end up being nothing to anyone. So you really need to dial in who you want to work for, who you do the best work for, and then create your messaging around that so that you attract more of that work. And it's okay if it's a price conversation to tell people and educate people about why you charge what the rates you do. Like most people don't understand it. They've had a friend who's had their bathroom renovated for 20 grand and they just think that's what bathrooms cost. They don't understand the full dynamic.
Yeah. I mean, I think you covered some really powerful points there, Matt.
Look, this has been awesome. I feel like we could talk forever on this topic. We definitely seem pretty aligned with the majority of it. But in interest of time, I suppose, what's a good place to sort of, framework, practical application, something that we can say to you guys out there, like where do they start in order to get some of their profitability dialed in?
Yeah. So I think I mentioned this profit leaks detector. I would highly encourage everybody who feels that they are not an above average profitability company to really say, hey, I'm going to allocate some of my time to fix profitability. What's cool is that can make such a big difference so quickly. So definitely do that. Come to our website, get the profit leaks detector. It will help point you towards which chunk of your business has the greatest opportunity. And then we have this technique that I'll share with you. It's called the 50-20 principle. And the idea is, of the various chunks of your business, maybe you're doing really good where all your staff are top notch and all your customers are top notch, but maybe you're offering it to too many market segments. Some of your subcontractors are not top notch, and of the various services that you offer, some are real high performers and some are low performers. So the profit leaks detector helps you dial in which chunk of your business has opportunity to elevate profitability, and then to apply this tool, the 50-20 rule. The way the 50-20 rule goes is to identify the worst 20% in that area and to cut half of that worst 20% in the next 30 days. So let's take an example. Let's say you offer 20 different kinds of services. Okay. Of those 20 services, it's highly likely that 4 or 5 or 6 are responsible for most of your revenue, are getting you most of the love from your best customers with a high long-term, customer value. But then probably the worst ones are either costing you money or they're like on the books, but hardly anybody takes you up on that. The challenge is every time you offer that, what's going on? Either, God forbid, you're getting a customer to buy it, but it's a thing you're not very good at delivering. You have a customer satisfaction problem. It sucks up a bunch of time. That's a big negative. Or even if you're okay at it, but it's not really your sweet spot, Matt would probably tell you this right off. The more you talk about stuff that's not your sweet spot, the more you muddy the water trying to get the perfect customer from buying your best stuff, because you're like, we do this and this and this and this and this. And by the time you get to the fourth comma, they've already forgotten the 2 things you do great, right? You sort of muddied the water. So this 50-20 principle, very, very powerful, because first of all, it's helping you get rid of low performing items. But we're not saying get rid of all the worst 20% right away, because there might be a reason why one of them is hard, or 3 of them, or your nephew's pet project or whatever it is. But usually half of that worst 20% is super easy to get rid of. So do that quick, and then you get a boost. You build a little momentum. And then if you want to take another crack at the remaining bad stuff in that one stovepipe, great. Or maybe move to the next stovepipe and say, okay, we got to, tune up our subcontractors because we have this bad painting subcontractor that's delaying our projects and creating a lot of customer sat problems for us.
Yeah, absolutely. Awesome. Well, okay, so if you guys out there, head across to theprofitdoctor.com. All the links are going to be in the show notes, and there'll be a link to the leakage detector as well. If you have any questions about any of this stuff, if you've got your own feedback or anything that you need more clarification on, let us know in the comments when you see this come through, email, socials, whatever it might be. I'm sure I can rubber arm Ben to coming back on the show and answering some of those. Otherwise, Ben, thank you so much for your time. Very interesting. I think, this conversation is one that will never, ever get old. There's always room for improvement when it comes to understanding finances and numbers and, profitability within a business. And so I just encourage you guys to, regardless of, your accolade or your background, really, to start learning this stuff because no one's really going to do it for you. You got to get out there and learn these things. The irony of me having this conversation with you, Ben, is a testament to the fact that anyone could learn this stuff because when I started in business, I had my head in the sand for years when it came to finances because I just didn't want to look at it because it terrified me and I was too afraid of it. But, over the years, the only way you succeed is really by understanding these things and building a good team around you with people that can help you sort of make the right decisions within this space. So, but it all starts with you guys, right? So hopefully this has been a useful podcast to get out there and go get them.
Thanks, Matt. Let me just leave people with one simple thing. Every hour the 10X rule, every hour you spend trying to improve the profitability of your business is going to give you 10 times the return of focusing on sales or operations. So even just 4 or 5 hours a week, maybe even 2 to 4 hours a week will make such a big difference. So come join me over at profitdoctor.com, PROFIT, doctor, DOCTOR, spelled the same in Australia as here in Austin, profitdoctor.com. Got a lot of tools and resources, a lot of videos and stuff like that. You can hear from some other business owners like you. I love working with owners of trades businesses because in many cases, they came up through the trades. And so just a little bit of extra knowledge and toolkit around how to improve profitability can make a really big difference. So hope to see some of you in our programs where we can help you improve profitability, like in 90 days to have a lot more profitability. And it just makes a big boost and makes going to work a lot more fun.
Awesome. Well, that is a wrap. Hey guys and girls, how would you like all of the value adds left behind from our podcast guest all put together in the one spot? We've pulled every tool together, every template, every resource shared on the show, and we've packed them all into the Tradie Academy. It's free to join and it's built by the team behind the SiteShed and Tradie Web guys. Inside, you'll get marketing tips, business tools, and first access to future resources, all in one simple dashboard. Just head across to tradie.wiki/pod. That's tradie.wiki/pod. The link's in the episode description. And once again, you just log in once and then you're all set. And if you want to get notified of upcoming episodes, hit subscribe or follow.